Hey, what's up, stock compounders? Brad here. So I just watched an interview on YouTube with Chris Meyer, author of 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. It came out at the end of June 2020, and there were a lot of little nuggets in there that I appreciated. So I wanted to pull those out for you guys, share them with you. I will link in the description to the full interview. It's about an hour and 15 minutes if you want to take a deeper dive on any of this. But I wanted to share my highlights from Chris Meyer's recent interview. The title of the talk is How to Hunt 100 Bagger Stocks and How to Kill Bad Ideas. Okay. So this was interesting. Chris Meyer started his career in corporate banking, making loans to businesses. And it really trained him to think about the downside first. Look at the balance sheet of these businesses and try to assess, okay, what is the probability of failure here? That's such an important thing when you're lending a company money. Are you going to see that money back, right? And I think this is a huge benefit that Chris Meyer got here, to learn very early on to look for the downside, risk of losing money. So I imagine that's really helped him as an investor. He was asked about his ideal investment. What would it look like to have an ideal investment opportunity? Well, it's a business that produces lots of free cash flow. It has a long runway for growth. You can hold it for a long time. It'll compound your money for many years. It generates a very high return on invested capital, which is something we've talked about before. It has the ability to reinvest the cash flow that it generates to consistently earn high returns, right? So you're earning high returns on this initial capital. You can reinvest that into the business to generate more high returns. And that's really how you compound over the long term. It's got to have a strong balance sheet, which means the assets are significantly greater than the liabilities. The debt is good debt, much more so than bad debt. There's things to look for on the balance sheet. The CEO would own a lot of stock, okay? This is a big one for Chris Meyer, and would preferably be on the younger side. So for Chris, talking about CEOs, the younger side is 40s or 50s, right? So the CEO themselves has a reasonably long runway ahead. They're going to be with the business for at least a couple more decades. And then, when all of those things are in place, he just sits back and watches it compound for years and years. So that's kind of the ideal investment according to Chris Meyer. And then he was asked, he had a big bookshelf behind him. He was asked to pull out a couple books that might be interesting, that not many people know about. And one he pulled out was called Humble on Wall Street. I believe it was published 1975. I've never heard of it. So that intrigued me. And one takeaway that Chris got from this book, Humble on Wall Street, it's so important to have ownership, to have management with skin in the game. Okay, and we're going to come back to that again and again. And then he also pulled out a book that inspired his book, 100 Baggers, which is called 100 to 1 in the Stock Market by Phelps. That was published, I think, in the early 1970s, and it covered a 50-year period from the 1930s to, I don't know, maybe it was the 1980s, something like that. Might even have been 1920s to 1970s, in search of these stocks that return 100 to 1. So that really inspired Chris to make an updated book about 100 Baggers. So he was asked, what are the real key ingredients to finding 100 Baggers? And he said if he had to do the book again, he would put more emphasis on these things. He would put more emphasis on insisting on having a high return on capital. Okay? Companies that can maintain that high ROIC. That's such a theme in the realm of 100 baggers. It's unusual to find 100 baggers that don't have that consistency in generating a high return on capital. The ability to take profits and reinvest them to get a high return on those profits. Okay, that's compounding. All right. In the real world, it's hard to find companies that can do that can reinvest, ideally all, but even the majority of their profits back into growing the business and earning that high return. It's hard to find those kinds of businesses. Usually they pay a dividend or there's some other leak with the cash flow, okay? Or with the reinvestment. There's some kind of leak. Not all of it makes it back into the business to grow the business. And so Chris Meyer actually isn't crazy about dividends. There's a time and a place for dividends, but if you're paying out dividends as a company, that money is not getting reinvested back into, growing the business, compounding your money. Sure, you can take those dividends and buy back the same stock with those dividends, but there's some inefficiencies there. There's double taxation, and little things like that can really eat into the compounded returns over time. So he's not crazy about dividends. And then the third one, you want companies that are on the smaller side. A company like Apple, it's a great business, but it's not going to be a 100-bagger from this point. It's too big, okay? There are real limits to growth when you're a very big company. Same thing with Warren Buffett. There are very real limits to the rate of return that Warren Buffett and Berkshire Hathaway can generate because they're so large, okay? Same thing for a business. So that's, the median market cap at the beginning when these 100 baggers were being studied. They started out at around $500 million market cap, okay? Which is pretty small. Obviously, it's a very small, it's on the small end of small cap stocks. But it's not tiny, 500 million. So, that's important, staying on the smaller side. And there's no cutoff, there's no threshold. It tends to be more likely if you're starting with a smaller company that you're going to end up with a 100-bagger versus, say a mid-cap or a large cap company. He was asked, where do you get your ideas? He does a lot of reading. He attends, annual meetings like Berkshire Hathaway. He attends the annual meeting for Fairfax Financial, which is Prem Watsa's holding company. MOI Global, he mentioned, which he's been doing virtually, which has been great. And, tips from other investors, companies that other investors are really excited about. They share them with him. He dives in and he finds some companies that way. But really the core of what he's doing, he has a watch list that's, been developed over the years, companies that he really understands, and he knows what price he wants to get into those companies. So, more often than not, he's just keeping on top of the companies in his watch list. He's making sure he's up to date with any of their quarterly or annual filings, conference calls, things like that. Less so about actively finding new ideas. And he also says we need a way to filter stocks. There's, thousands of public U.S. companies, right? We need some way to look at a smaller pool, right? And some of those ways that Monish Pabrai is a big fan of, companies that are, eating back their own stocks, buying back stocks, called the Uber cannibals, companies that have recently spun off, okay? There tend to be inefficiencies there. And shameless cloning, of course. Learning what the greatest investors in the world have bought recently through 13F filings. But another filter, like I mentioned before, that Chris Meyer really likes is filtering by insider ownership and only looking at the companies that have an insider ownership above 15%. Okay? Really means the management team and the members of the board own 15% of the shares outstanding. That creates alignment between people who are making the decisions about, how the company moves forward and shareholders. There's incentive alignment there, which is really important. He says now is probably the easiest time in history to find stock ideas. We have all of these, internet-based tools right at our fingertips. It's so easy just to get newsletters from investment managers and to look at the 13F filings. There's just so many ways to get ideas. Of course, the magic formula screener I've talked about on this channel. The acquirer's multiple is another screener. There's no end of ways to find stock ideas. And it's easy to spend a lot of time focused on generating ideas. But to me, the more productive uses of my time tend to be watching interviews by people like Chris Meyer, Monish Pabrai, Howard Marks, right? Learning, kind of honing my investment philosophy versus, just digging through screeners and things like that. So I'm glad to be doing this today. I'm glad I took an hour to watch this interview and kind of try to distill the wisdom in it for you guys. How to kill ideas. So what are stock killers for Chris Meyer? Lots of debt. Monish Pabrai has talked about how, when he went through and tried to find, the biggest mistakes for great investors, right? He looked at, investment ideas where these great investors lost a significant amount of money. And he tried to reverse engineer, could it have been spotted that those were dangerous investment ideas before they were entered into? And the biggest red flag for those investments was high debt, right? High leverage. So Chris avoids companies with a lot of debt. And he avoids deeply cyclical companies, mining companies, tanker stocks, companies like that. He avoids little biotech companies with one or two drugs where, the entirety of the revenue depends on a couple drugs working out. He says there's not a lot of great businesses, right? So a lot of companies that return a low return on invested capital. They don't have a moat. If there's any hint of fraud or accounting shenanigans, Chris is out of there. So those are a few things that are an easy no, which I think is important for yourself to have a list of things where it's like, okay, I'm done. This company doesn't pass this handful of things that I need to be able to check these boxes, right? So that's a powerful thing. He was asked about management. How important is management? Early on in Chris's investment career, management wasn't that important. He didn't put much weight on management. He thought, it'll come through in the numbers if management is strong versus if they're weak. I don't actually need to pay much attention to those soft characteristics of the business. Over time, as he's gotten more experience as an investor, management, he has more and more appreciation for needing to assess the quality of management. Investing is a people business. What do managers do? They manage people. So that's really important that they have those skills. Capital allocation over time has a big impact on returns. Who's allocating that capital in a business? It's the management. And then, of course, you have honesty of management. Are they trustable, right? What have they done in the past that indicates that they're either trustworthy or not trustworthy? Now, there's always a trail. There's always hints. There's always evidence based on looking at what management teams have done in the past. Those are all very important to pay attention to. I mentioned this earlier, but on dividends, okay? What about dividends? How do dividends factor into 100 baggers? Chris says, if you're looking for 100 baggers, you really need the full compounding effect, okay? You need all of those profits that the business is generating to be reinvested back into the business. So dividends, it's tough. It's tough if you're a company paying out, large dividends to become a 100 bagger. That doesn't mean it's not possible for someone receiving the dividends. Maybe it's a little bit easier if they're just plowing those dividends right back into the business. But if we're just looking at the business, that it's definitely a hamper on potential 100 baggerdom. Like I mentioned before, if you're getting the dividends and you're plowing them back in, there's some leaks there in terms of double taxation. So important things to keep in mind. Really, dividends aren't much of a consideration. Is this kind of final line on that. In this original book, the Phelps book, 100 to 1 in the stock market, Phelps says dividends are an expensive luxury. They slow down compounding. So, consider that. In terms of positions, he was asked about, how concentrated is his portfolio. Coming into 2020, he had 15 positions. What he realized, based on the pandemic, was that a lot of the stocks that he had in his portfolio had these connections between them that he hadn't seen before. Travel-related connections. And so he decided he was too concentrated in certain industries to feel comfortable with. And the pandemic really showed him that. Sometimes it takes a catastrophe, a recession, some kind of cataclysmic event in the stock market to see connections within your portfolio that you didn't know were there. So he started with 15 at the beginning of 2020. He now has 10 positions. His ideal is really an equal weighted on a cost basis, kind of 10 stock portfolio, okay? So he spends about 10% on each position, on 10 different positions. And the reason he likes that is if he were to order his best idea down to his 10th best idea, what he's found is his best idea isn't necessarily going to perform the best. It might be his 6th best idea that performs better than all of the others. So he doesn't think that he has enough skill to be able to weight those 10 positions, right? He has enough skill to be able to pick his 10 favorite ideas, but within that, he can't pick out which are going to do the best. So, it makes the most sense for him to just equally weight them so that, at least he's got an equal stake in the 1 or 2 or 3 that perform the best. And that made sense to me. That's a very intuitive explanation of why you would have an equal weighted portfolio like that. He doesn't want to have any more than 20% in one idea, okay? Which I was a little surprised by. I think it's because he's managing money for other people. and it can be harder to really ride one bet to like half of the portfolio when you're managing money for other people. I think there's just kind of an external pressure there where it's harder to stomach that kind of concentration. And he doesn't want too many connected ideas, like I said before. So he wouldn't want more than one hotel stock, more than one oil stock. You know, he wants to not have too much exposure to one industry. And then last question I'll cover, he was asked, what is your edge? What is your edge as an investor? And he said, you know, it's really hard to have an analytical edge these days with all of the tools available, with how easy it is to access information. He says for most investors, and this really resonated with me, for most investors, the best edge is patience, okay? A long investment horizon. There is so much competition when it comes to trying to pick the stock that's going to perform best over the next month, the next 3 months, the next 6 months, right? There's just so much mental effort going into trying to win that game, the short-term game. So if you have a longer-term time horizon, 3, 5, 10, 20, 30 years, that's a huge edge because you can look at companies very differently as an owner than you would be looking at them if you were just trying to anticipate what the price was going to do over the next, 3, 6 months. It's a big difference. So that's an edge that Chris Meyer has, is having that long time horizon. He wants to buy a company and he wants to get out of the way, let it compound his money for him for as long as possible. That's the ideal. The other edge he says he has is paying close attention to management incentives, like I mentioned before, a high insider ownership. This is something I've been paying more attention to in my investment process, which you've probably seen. The video I made yesterday, I have kind of an insider ownership check box on my checklist. When I look at a new investment idea, I want to know what's the insider ownership percentage. And then, of course, Charlie Munger has a great quote. He says, "Show me the incentives, and I'll show you the outcome." From Charlie Munger. And, really, if you understand what drives management, if you understand how they're financially rewarded, it's a lot easier to understand how they're going to make decisions about the company moving forward. And you really want their incentives, particularly their financial incentives, aligned with your incentives as an equity investor. Okay, super important. So that's it, guys. That was a lot, but it was a great talk from Chris Meyer. Check it out in the description if you want to get all of it. But yeah, I love doing these. I'll try to do more. Hopefully we get a lot more interviews coming out from Pabrai, from Bill Ackman, from Howard Marks, Ray Dalio. It's just fantastic when we can spend an hour with these brilliant minds and just let the wisdom soak in. And it's awesome that I get to share it with you guys and even soak it in more by kind of pulling out the nuggets that impacted me most. But anyway, guys, that's all I have for today. I will see you in the next video. Take care.